The government offers the largest market for low-risk fixed return investments through treasury bills and treasury bonds. So if you are a beginner, risk-averse investor, and you are looking for a fixed return, a guaranteed income, then the treasury bills and treasury bonds are your preferred investment. Today we are comparing treasury bills and treasury bonds. Don't go away. We are looking at the comparisons in 3 seconds break. Support this channel by giving us your subscription. Tell us in the comment section what you need us to improve or what you would want us to discuss next, or a question about this video. Give us a thumbs up and share this information to another person. Sharing is caring. Those parameters will help the algorithm to push this information or the video to other people. Let's look at the similarities between a treasury bill and a treasury bond. Number one, who issues and what are they? These two instruments are issued by the government through its agents, that is the Treasury and the Central Bank. They are low-risk fixed return borrowing instruments. In other words, we normally call them IOU papers. They acknowledge or they form a contractual agreement between you, the investor, who is giving money to the government, and the government that is borrowing from you. So it's a lending arrangement or a borrowing agreement, which means then that it is for a fixed period of time, after which you will be paid back your money invested or the capital that you put in that investment, what we call redemption. And on top of that, periodically as agreed in the terms of that engagement, you shall be paid by the borrower, that is the government, interest, which we technically call coupons, in specific dates over that period of time that you're investing. Number two, what do you require, or what is the basic requirement? For you to invest or take advantage of investing in treasury bills and bonds, you shall be required to have a CDSC or a CSD. Number two, requirement. For you to purchase a treasury bill or a bond, at the very minimum, you'll be required to have a CSD account with the central bank. In the description, I'll give you a link to a video on how to open or create a CSD account through the Thou CSD app. That account is what holds the valuation account and your portfolio account with the borrower, that is the government. Number three, auction and bidding. The two instruments, that is the treasury bills and bonds, are sold by the government through auctioning and bidding. And in bidding, we have two forms. We have competitive bidding and non-competitive bidding that distinguishes a big investor to a retail or a small investor. In this case, the distinguishing amount is 2 million worth of investment. If you are investing 2 million and above, either in the treasury bill or in a bond, you are given an opportunity to bargain or issue a term of the rate of return that you would like to be paid by the government. But for those who are investing less than 2 million, they assume the rate of return that as a result of the average competitive bidders. Number four is type of taxes. Both treasury bills and treasury bonds are taxed on a withholding basis, which means that the government, the central bank, which is the payer, the trader on behalf of the government, withholds the tax, meaning that the coupons that will be wired to your settlement account will be returned net of the tax. That is what it means by a withheld tax. The central bank, as the agent of the government, deducts the tax from your return or your interest for one-word payment to the government. So whatever you receive is net of tax. Number 5, the type of return and risk profile. These two instruments, the treasury bills and bonds, they pay a fixed return over the given period of time, and they are rated as low profile, low risk profile form of investment. We say they are of a low risk profile when it comes to the government, because a government can actually borrow to pay back what it had earlier borrowed. Another case is on stability of a government. The chances of a government defaulting on its borrowing are low and only occur in exceptional extreme cases. Next, we'll be looking at the differences between the treasury bill and treasury bonds. Thank you for your subscription and welcome back to the differences between the treasury bills and treasury bonds. Number 1, the frequency. This is a question of how often are these instruments issued. Treasury bills are issued on a weekly basis. They are floated on a weekly basis, meaning that if you can afford to accumulate the required minimum amount for that investment, you will have a new bill that you can purchase from the government. On top of that, the government floats not just one, but several bills or several instruments in every issue, which gives you a flexibility. You can choose the one that suits your goal best. Because of the matching, you need to match your goal and the vehicle that you are using to invest your money in order to achieve the goal. In that, if you want to achieve a goal in 3 months, you would require a bill that covers or matures in 3 months or less. If you want to use your money or the accumulated amount in a year's time, you need a bill that matures in a year's time, or one that matures in a shorter period, maybe the 91 days or the 181 day, that you can reinvest after the first one matures. For the treasury bonds, they are floated or issued once every month. So they are issued on a monthly basis. And again, just like the treasury bills, the government floats not just one, but several bonds per issue, which gives you flexibility. You will be able to choose the bond that suits your goal or your objective because of goal investing and purpose investing. Number 2, the minimum capital required. How much are you required, or what is the minimum amount that you are allowed to invest in treasury bills and bonds? For treasury bills, the minimum amount that you can invest direct in the primary market, that is when you are purchasing directly from the government, that is the central bank, the minimum amount per bill, per instrument is 100,000 shillings. While for a bond, the minimum amount that you can purchase a bond is 50,000 shillings. But one can purchase more than one instrument. You can buy more than one bond at a time. You can buy more than one bill at a time. But you would require to bid afresh for each purchase. That means that if you have a lump sum, let's say 1,500,000, or you can divide that money into chunks of the minimum amount and in multiples as required or as prescribed in the prospectus. You purchase as per the prospectus. If you are told that the multiples are 50,000 and you have multiples of them, you can either purchase different bills or different bonds to exhaust the amount of capital that you want to invest, or you buy a single instrument. Number 3, what is their horizon like? That is a question of the maturity period. How long will it take for that purchase or investment to mature? For treasury bills, the maximum horizon, the maximum tenure of a treasury bill is 1 year, which translates to 365 days. In that year, a government can float 3 types of bills. 1, we have a treasury bill of 91 days. That is a bill that matures in 3 months. You can have a treasury bill that matures in 6 months. That is 181 days. And another type of a bill that matures in 1 year or in 365 days. And the government can issue 3 bills at once. The 91, the 181, and the 365-day bills, which as an investor you have a choice to choose whichever bill that you would want and the one that suits your goal or the investment that you want to do. For bonds, treasury bonds, their horizon ranges from a period more than 1 year to a maximum of 30 years. A bond would have an horizon or a tenure in between over 1 year to 30 years. And in most cases, for bonds, a prospectus, which is prescribing the condition and terms of a particular issue, can have several bonds in it, as it is provided for in the redemption structure. If a bond has been issued for, let's say, 30 years, the redemption periods, depending on the amount that you have invested in that particular bond, the government, in a way or in its effort to manage its debt, can prescribe a redemption that is shorter than that period, which means that there are redemptions within the maturity redemption of the 30 years. Such will also be treated as individual bonds. So in this case, for a bond, the maximum period will go up to 30 years, and the shortest period must be more than 1 year, because as a similarity, as we had looked at, is that bonds and bills are the same. These are borrowing instruments issued by the government to obtain funds from the domestic or the international market. But we classify them as treasury bills and bonds owing to their horizon. Whatever instrument has been issued by the government as IOU paper but matures within a period of 1 year, that one will be a bill. Instruments that mature in more than 1 year, those are bonds. So the main distinction between a treasury bills and a treasury bond is the horizon, the maturity period. Number 4, are returns, are how they are calculated. For treasury bills, these instruments are sold at a discount. These are discounted instruments. What that means is that the rate of return, or the return from a treasury bill, is paid at 0.0. It's not a future return. What happens is that the amount, or the minimum amount, the amount that you have invested, the rate of return that is given, you are supposed to deduct from your capital amount. So that means that you are left with the return. So you invest, what you pay after bidding is less, is the agreed amount or the capital amount less the interest or the rate that has been provided for. For example, if you are buying a treasury bill of 100,000 with a par value of 100,000 at a 10% return. As an example, what will happen is that you will pay the government 90,000 plus the tax element. That is, you are going to pay 91,500 because you will pay 91,500 to be left with 8,500 because the return that is you are left with as the discounted amount is net of tax. You pay the capital amount and the tax on that amount, which will be onward transferred to the government as a tax through the agency that collects taxes. For treasury bonds, the interest is paid as a premium, or is calculated as a premium, meaning it's a future payment. So if you are buying a bond with a value of 100,000 at 10% rate, it means that per annum, or at the end of the year, you will have earned a total of 10,000 as interest, which is inclusive of the tax. But as a distinction, we should now give us number 4. Treasury bills and bonds will differ in the way the returns is paid. For a treasury bill, the entire interest is paid at once and as a discount. But for treasury bonds, the coupon or the interest is paid semi-annually, which means you get a 50% of the interest due in a year after 6 months, and the other 50% comes after the other 6 months. Semi-annually, semi means 2, bi means 2. So it can either be read as semi-annually or biannually. So the interest, the total amount of return that you expect or you will have earned in a year shall be divided into 2. And that is an element that is worth noting, that for purposes of compounding or building up your investment blocks, because compounding is one of the key elements in investing. If you are purchasing or investing in a treasury bill and the interest being discounted, you had a capital of 100,000 and you are left at hand with 8,500 shillings. What you need to do is, if you consume these 8,500, you have destroyed the miracle of compounding. So what should happen is that you should find another investment vehicle that accepts that minimum. And a good example is a money market fund, where you put that as additional capital for compounding element. The same way, for a treasury bond, the first interest when paid out, the first 50%, because treasury bills and treasury bonds, or treasury bonds, because the bills are discounted, treasury bonds, the interest is not automatically reinvested. So to take advantage of compounding, once the amounts of return or the coupons are wired to your settlement account, you should not feast on them. What you need to do is look for another investment opportunity and apply that as capital. It could be a money market fund, or if you have invested substantially that the coupons that are paid are enough to buy another treasury bill or bond, would rather reinvest in order to get the blessings of compounding and increase your investment building blocks. The other difference is taxes. We looked at a similarity in taxes by their nature, that they are withheld taxes. But as a difference, we'll have to look at their types. There are different types when it comes to treasury bonds. For treasury bills, their withholding tax rate is 15%. But for treasury bonds, it varies depending on the type of the bond and the duration of investment. For treasury bills, we are not talking about duration because it is capped at 1 year. But in order to incentivize, in order to encourage as an incentive for investors to put their money for a longer period of time, the government offers an incentive through treasury bonds whereby those who invest for an horizon or a tenure of more than 10 years, the withholding tax is at 10%. They get an incentive of 5% as a saving, which now adds up or comes as an additional building block to their investment because they get a higher amount of return compared to those who are saving for a shorter period of time, not withholding the risk of maybe reduced inflation rates that may give them better opportunities. But for this one, treasury bills are at a fixed withholding tax rate of 10%. But for bonds, the rate depends on the type of bond because we have the infrastructure bonds which are tax-free. They are not taxed at all. Then we have treasury bonds of an horizon that mature in a period of more than 10 years. They have a reduced withholding tax rate of 10%, as we have said. Then the other bonds are taxed at 15% withholding tax. Because of goal investing or purpose investing, it is very important to match the maturity of the investment to the time of that goal or when the funds will be needed. For that reason of matching, it might be necessary because in the bond markets, it will take time to liquidate those instruments. And the worst scenario is if you are going to liquidate your investment by selling it back to the central bank because it is purchased at a discounted rate by the central bank because central bank is a purchaser of last resort. That may necessarily mean you require an investment term that will mature several months to 1 year to the time that you need the money. That said, it will mean that you would require another opportunity where you need to park that money after redemption, waiting its use for the purpose that it was intended for. Even during that time that the money is being parked, it is supposed not to be idle. It's supposed to be compensating itself for inflation and its purchasing power, and if possible, it should also be actively generating a return. A good vehicle to park such money would be a money market fund because of its flexibility, because of its liquidity and accessibility. Lastly, thank you for watching the video. Share the information, engage us in the comment section and give us a thumbs up.